We have a balanced energy transition strategy. What we are looking to do is to be able to do the right things for now and for the future, both for our shareholders and for the planet. And so what we announced in Capital Markets Day just a month ago is that we are focused on creating more value with less emissions. And what that means is we will continue to pull all the levers to drive further value growth in the organization, while at the same time we will continue to meet our aggressive emissions reductions targets, both for our own emissions as well as for our customers.
There's this speech of yours, the New York speech, as people are calling it, where I think you were quoted saying you're going to be ruthless in the pursuit of higher returns for shareholders as well. There is a whole bank of shareholders that are saying, how is it that Shell and its European peers is trading at such a large discount to those of the US energy majors? But is it inevitable that there will be a discount for a whole host of structural reasons, plus the fact that the European majors, of which Shell is at the front, have just got a different attitude to their transition strategy?
I think firstly the focus and what I said in New York is we're going to be ruthless in our focus on performance, discipline and simplification. And those are key, both for our conventional business, our oil and gas business, as well as our energy transition businesses. Because the way we're going to be able to actually steward the company through the energy transition is by delivering shareholder returns and doing it in a scalable way for the coming years. And so that's where we're really focused, Steve, just to make sure that we are driving that well. On your point around the valuation gap, we do think that the actions that we have announced at Capital Markets, they could bridge a significant portion of that valuation gap. We have already announced that we will be more disciplined with our capital, bringing the range down to 22 to 25 billion in 24 and 25. We have announced a $2 to $3 billion OPEX reduction. And all of that will result in some 10% free cash flow per share growth per annum between now and 2025. That, in my mind, is going to be a compelling investment case for our shareholders.
Some shareholders, it's been talked about, don't want Shell as it is. They want the hydrocarbon assets parked separately from the renewable asset. And when you look at the return on investment, just on that purely one metrics, you can see what they're talking about. 5 to 10% looks like the mean for returns on investment on the renewables. High double-digit or much higher double-digit returns coming from the hydrocarbons as well. Can you satiate those two camps and keep Shell together?
I believe we can. I think Capital Markets Day was an important step forward, and the feedback we have been receiving since then from many of our shareholders, and of course the response of the share price itself, I think is an indication that we are on the right track. What's going to be key is that we continue to be disciplined in the way we allocate that capital. We have a number of low-carbon investment opportunities that are 12+% returns. And that is where we are focusing, and that's what we're pursuing. And you've seen that also in areas like, for example, our biofuels, or, for example, in our EV charging. Those are the sorts of returns that are possible. We just need to make sure that we focus on the right countries that have the right conducive environment fiscally and in terms of the right support where we could actually deliver those sorts of returns.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.